Welcome to Econoday Unplugged. Each week, our expert team explains the relationship between economic announcements and market reaction. For over 25 years, Econoday has provided value for the investment industry, amassing a comprehensive, machine-readable database of global market events. Econoday provides solutions for macroeconomics, sovereign debt, agricultural commodities, and historical data, all delivered via API, XML, and HTML. Connect the dots with Econoday. Subscribe to the Econoday Unplugged podcast and go to www.econoday.com to follow market events.
Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, 12th of March 2019. As usual, Mark Pender is stateside and I'm Jeremy Hawkins here in London. So Friday's surprisingly soft employment report has thrown the proverbial cat amongst the pigeons as far as prospects for US economic expansion are concerned, while for the Brexit saga at long last, we pretty well reached make your mind up time. Meanwhile, neither the ECB nor the Bank of Canada is now quite so confident that the economic slowdown at home will be only short-lived. So lots to talk about then. Mr. Pender, employment in February. How can the consensus be, was it 150,000 short or something?
Something like that, but it was, shockingly small at 20,000. But you have to average the months together, and the other month was shockingly large at 304,000. And the first reading, if we remember back in December, was since revised sharply downward. That was over 300 as well. So there's been a lot of volatility in the economic data, which isn't going to rest very well with the statistical agencies, because they've been battling for years this question of seasonality and during the winter months, and it really does seem to be appearing now. We had retail sales yesterday, Monday, and it showed a swing higher from really devastating losses in December. Really way out of what anyone could have expected of the numbers. So there may be, I think we really do have to wait. We have to see how this is going to play out. I don't think the Federal Reserve policymakers are going to be jumping to any conclusions on these numbers, especially we'll have to, I think, get into some of the spring numbers, which are still kind of away because we've been delayed because of the government shutdown, delaying the data. And so the U.S. right now, the economic numbers have definitely been soft. We got another surprise today. We had the core CPI, which is almost always easily forecast. For the first time, really since August, it slowed to a 0.1% rise. And even though from 0.2 to 0.1, from 304,000 payroll to 20,000 payroll, that core is almost as much of a surprise to forecasters as the change in the employment report. So we're getting.
I've got to ask you on that, Mark.
Yeah.
If I'm right, didn't we see a pickup in the wages number on Friday? And yet inflation is still where it is.
Yes. Well, yes. We saw a 3.4% average hourly earnings, which was above expectation of 0.4% rise on the month. And these are really at the top of the expansion. And really, it's funny, we should talk about this. I don't want to digress too much, Jeremy, but we've spent this last several years saying what happened to the Phillips curve, what happened to wage inflation, why isn't it here? But if you look at the unemployment rate, which has been going down, and if you look at average hourly earnings, which is going up over the last 10 years, it makes a nice little X. So they do seem to be coming back in line. Average hourly earnings have accelerated a little bit in the recent months, which does help restore the fundamental supply and demand in the labor market. But if we get a downturn in the labor market, then it's kind of interesting that would occur at the same time when we might be talking about accelerating wage inflation. But in any case, I think right now the U.S. data is in a wait-and-see mode. We're in a bumpy, turbulent period right now, and we have to just get through this to find out where the economy really is. And that will probably be a couple of months from now. So I imagine the Fed is going to kind of go into a holding pattern right now. But now, is it fair to say that you're seeing the same thing in Europe, that you saw volatility on the downside late last year, and now are we seeing volatility on the upside early this year?
It's right. It's quite interesting. I mean, just looking at this period around Christmas time, as you say, some of the seasonal adjustment problems they have, looking at the data throughout the course of the year, they tend to, really coalesce around that time. And it's interesting, particularly with regards to, let's take the industrial production data. Now, if you remember, I think on the podcast not so long ago, we were talking about some, pretty horrible numbers coming out right across the Eurozone as far as December was concerned, notably out of Germany. As far as January goes, though, we've seen pretty well, apart from Germany, which we can talk about perhaps a bit later, but looking at Italy, Spain, France, having seen industrial production albeit collapse in the end of last year, we've seen very strong rebounds coming through in January. And exactly the same we know now took place in the UK as well, because we've had the UK industrial production figures out this morning for January. Same pattern, down sharply in December, back up again in January. So now, whether it is due to natural reasons or it's something to do with the fact that the guys who produce the stats can't actually seasonally adjust these figures, we really don't know. But it's an interesting pattern. And I suppose if you're an investor, it's got to be something you've got to be aware of and perhaps make you a little bit more cautious about how you interpret the month-on-month data, because you really could draw the wrong conclusion.
Well, let's talk about German industrial productions, considering it is so important in the global scheme of things. And
that's right. I mean, I was going to say the oddball as far as the Eurozone industrial production figures for January are concerned was Germany. France, Italy, Spain all had very good increases. However, Germany saw a 0.8% decline. But again, just going back to this thing of putting it into context, December was originally reported at down 0.4 in the month. That was revised up to 0.8%, which tells you at least you can't trust the initial German first provisional data, because they are subject to pretty hefty revision. But even there, we're talking about, albeit in the opposite direction to the rest of the Eurozone, still very striking volatility between the months, which again raises doubts not just about the quality of the data as it's initially issued, but also whether seasonally adjusting it correctly or not.
And
so it's certainly interesting.
What's the breakdown in Germany between domestic demand and export demand?
Well, one reason it's got to be said, we've seen this surprisingly sharp slowdown in Germany. And bear in mind that they only just avoided by, effectively a decimal point, falling into technical recession at the back end of last year, is that exports are hugely important to the German economy. In any particular quarter, exports can be worth as much as 50% of total output. So because we've seen this slowdown in global trade, it's disproportionately impacted Germany compared to, let's say, the likes of the US, where obviously the net trade sector is that much smaller. So Germany in particular is very vulnerable to swings in global trade.
Do you think, though, we've had the general central bank move toward neutral over the last couple of months, really, since the Fed in late January. And now we're seeing this volatility in the data. I don't think it's going to affect the Federal Reserve, but as far as the global downward pivot that was very apparent in global monetary policy, will this disruption and we're taking it from the investor's point of view, of course, will this disruption make them think twice about the pivot? Is there now a greater chance that they'll step back from it and then resume an upward bias?
It's hard to say. I think one of the problems with certainly the short-term investors, I suppose by definition they're short-term, so they tend to react very much to the latest figures, even though at the end of the day those figures may not actually be worth the paper they're written on. But I think as far as the central banks are concerned, I think you're right. We have seen a general reappraisal by central banks about the state of the domestic economy, and invariably when you see statements attached to the rationale for the latest central bank move, invariably within that we'll see some reference to the fact that the global economy is performing more weakly than they expected. And I suppose we should just mention to listeners, as far as last week was concerned, the ECB, although they didn't make any changes to quantitative easing or interest rates as widely expected, they did, however, come out and change their forward guidance. So previously they've been talking about interest remaining at current levels, which as far as their benchmark is concerned, of course, is zero, through to the end of the summer. Well, they've now extended extended that through to the back end of this year. And at the same time of interest, which I don't think some people perhaps picked up on, they actually maintained their economic risk assessment. So they moved that down earlier on in the year, and they've left it still tilted to the downside, despite the fact they've extended their forward guidance. And indeed, they've also made some other initiatives, such as this TLTRO, this new cheap funding program for banks that they'll be introducing later on this year as well. So that very much reflects their concern. And just quickly on the Bank of Canada as well, they've been, until prior to last week, have been one of the very few of the major central banks essentially still talking interest rates up, and it just being a matter of time. Well, now, effectively, they've taken that out completely. They've dropped the tightening bias, and they're suggesting that rates pretty well as likely to go down as they are to go up now. And they revised down their forecast significantly. So I think, in broader terms, I think central banks are clearly, they don't look at one month's worth of data. They put a line through the last 3 months or so and really move on the back of that.
Well, and I guess the hint I'm getting is the risk. I mentioned it before, that they have over anticipating the slowdown. I don't know that this still has to play out. But let's talk about the wild cards now. We have not too much in the U.S.-China trade talks, developments there. We're getting a lot of developments in Brexit. Let me ask you just one question on Brexit, and that is, what proportion of the Parliament would not mind having a hard Brexit?
Well, it's hard to put a number on it, but certainly I think it's safe to say that the majority of Parliament does not want at least a no deal. Now, a hard Brexit could be defined as a trade deal which perhaps isn't as soft as some people would want in terms of the ultimate relationship we end up with the European Union. But in terms of a no deal Brexit, I think it's pretty well certain that if we were a vote on that tonight, and in fact we could see a vote on this tomorrow, but if there were one this evening, then it would clearly be rejected.
So the March 29th date is dead?
Not yet. In fact, I'll just give a quick update on Brexit, because as we speak, there's an awful lot going on, because there is a key vote taking place this evening on Tuesday. Essentially, it really does all boil down to today's second meaningful vote in the UK Parliament, which is just a few hours away. So this then is the last chance to get an agreement on the withdrawal bill in the House of Commons before the Brexit date on the 29th of March. Now, the pound, as we know, has been hugely volatile, and yesterday almost took off when it was heard that Mrs. May was flying back out to Europe, and the speculation was that she was going to come out with some announcement about revised Irish backstop. People remember this is the thing which keeps open the border between Northern and Southern Ireland, irrespective of what happens to Brexit at the end of the day. Now, as it turns out, what she came back with doesn't look as if it's going to fly. It's been described already as being potentially not legally binding. So in a nutshell, what it means is that then when we get to this vote this evening, what Parliament will be voting on is essentially exactly the same proposals that Mrs. May put forward back in January time. And if people remember, that was when she lost that vote by a record 230. So as things stand at the moment, it looks as if she's going to lose that vote. Now, that has a number of implications. One, if she gets hammered in it again, that could be the end of Mrs. May as Prime Minister. It could lead to another general election. But as things are currently written down, it would lead to a second vote then on Wednesday, which would be what you were talking about. It would actually be a vote on, does UK Parliament want a no-deal Brexit? And that will almost certainly be rejected. And if that's the case, then we have the third vote on Thursday, and that's going to ask Parliament whether they want to see an extension to the Brexit date itself, perhaps of 2 or 3 months. We don't know the precise word.
Where did that March 29 date originally come from?
Well, that originally was the 2-year agreement from the time when the referendum actually took place, or so from when the UK actually applied to leave the EU. So we had the referendum back in the middle of 2016. The UK actually put forward its request to leave the EU on March the 29th of 2017. So the March the 29th this year will be the 2-year period. So that was kind of laid down in the statutes.
And those were statutes that Parliament made.
Well, it's all part and parcel of being part of the EU. So if you want to leave the EU, effectively, you have to give them 2 years' notice.
In the EU, they're showing patience. They want the UK in, I guess. They want all this to...
They are, but I think, to be honest, I mean, what the EU really think of what's going on at the moment, it probably isn't printable. I think, they are so fed up with, they were told ages ago, well, look, I can get this deal through Parliament. And so if you're happy with it, all done deal. And ever since then, everything's gone backwards. So I think if Mrs. May loses the deal tonight, and who knows, something may happen and it actually goes through, in which case that's fine. We come out of, Brexit happens on the 29th of March. Everything will go through as currently agreed, and we'll have this transition period through to the end of next year. If that happens, then everyone's going to be quite happy about it, albeit very surprised. But it looks as if that won't happen, in which case, the EU is going to be scratching its head as to what on the earth we're supposed to do next.
Well, now you've been talking about in the UK the effects of Brexit disrupting business investment. I think you mentioned even consumer spending. What has it done to continental Europe? Did you see any Brexit effects there?
Yeah, I think definitely we're seeing increasing Brexit effects there. I think it's taken a while to feed through, but I suppose one of the classic examples, if you look at the German auto industry, the UK market is by far and away one of their most important export markets for the likes of VW, BMW, and so on. And they've been hit pretty hard by the fact that there's a lot of uncertainty about what they're going to do in terms of whether they're going to build the plants. And the icon of is the mini motor car over here, which is built in the UK. BMW now talking about shifting that back into possibly the Netherlands, possibly built in Germany. We've seen, away from Europe, the likes of Nissan and Honda talking about either not making new models they were planning to, or even closing down major plants in the UK if the Brexit deal doesn't go through as they want. So we're starting to see it, have an impact now.
What about actual economic numbers, capital investment, those kinds of things?
We're starting to see it. I think it's interesting when you look at, and again, I suppose because it's been perhaps a slower reaction in Europe, because it's, the main focus has been what's it going to do to the UK. But if you look at, the soft surveys, the business, and to some extent the consumer surveys, particularly the likes of the PMIs, when you look at some of the anecdotal evidence, a lot of it now is quoting about Brexit uncertainty. Because at the end of the day, firms don't know what they should be doing. Should they continue to be investing with a view to export into the UK? They can find new markets, whatever. And even when in some of the consumer confidence surveys now, the Brexit uncertainty issue quite often crops up because people are worried about, is it going to impact our job?
Okay, I want to play the devil's advocate here when it comes to those soft surveys. Is it right that the European PMIs have been actually coming back a little bit so far this year?
Well, only very fractionally.
I'm talking about the number.
The headline number itself.
Okay, so what I'm talking about is the selection by the editors of the commentary. And if they want to sell, if they want to get prominence in their report, they can select out issues that they know people will be sensitive to. So is this an empirical? And these soft data, we don't know. They don't tell you what their sample size is. There's a lot of mysteries. And I think looking at their quote rundown is one of those mysteries. What do you think about that?
Well, I think, to be honest, that probably within Europe, rightly or wrongly, the PMIs have always been perhaps more highly regarded, at least to some extent, I think, than perhaps on your side of the pond. To the extent that I'll say that if you look at when either the ECB or the Bank of England, or indeed any of the other European central banks not involved in the ECB, talk about international developments, they'll invariably mention what's happening to the global PMI, the JP Morgan market global PMI. And when they're talking about domestic developments, they'll virtually always talk about the latest domestic PMIs as well. So over here, they do carry a lot of weight. Now, how these individual products are sold by the marketers themselves, well, that's perhaps a different issue. But I think on the whole, not necessarily on a short-term basis, but by and large, the PMIs here have actually had a pretty good track record as to what's going on. It's not perfect every quarter.
But that's the number, right? Do you see that the commentary is maybe playing for sound bites?
Possibly, but to be honest, most of the commentary tends to be fairly structured. And I've got to say, when it comes to Brexit, I wouldn't say it's done in such an outlandish mode as to make people jump up and down about it. It does seem to say that, company replies suggest that Brexit is becoming an increasing concern for manufacturers or services, whatever. So I don't know. I guess I'm just used to looking at the PMIs over here because, rightly or wrongly, financial markets in particular do tend to react to them quite sharply. Okay, what else should we mention before we go? I suppose since we're talking quickly about the global economy, I should mention Australian GDP. We had their latest figure, which was the weakest fourth quarter, their weakest quarter-on-quarter number since the middle of 2016. So again, that fits in with the general slowdown, and also we had some pretty trade numbers out of China last week as well, which showed a plunge in exports. They were down about 21% on the month from a year ago for January, which again is going to fuel concerns about global economic slowdown. So it may or may not be the case that the recent data are perhaps somewhat overstating it, but there's a lot around at the moment to suggest that where the economy is headed currently is certainly on a flatter trajectory than most people are expecting not too many months ago. What else? Any other numbers out of your side of the world, Mark, we look at? Retail sales, you say you got this week?
Yeah, well, I already mentioned that they were a mess, a huge volatility.
I was wondering what's expected.
Relative what was expected, I guess. It probably, a rebound was expected, a solid rebound, and I guess that's what we got. But the numbers, they're just too volatile to rely on it. We also have to remember for retail sales that December is an unusually strong, by far the strongest month, and January is by far the lightest month. And the states, we make a month-to-month comparison. So to do that, you have to have adjustments bring down December, and you have to have adjustments lift January. Very kind of artificial, but that's the game, and I'm not sure it always works. I think things that really have to play out, but we have seen very weak vehicle sales so far this year, and the Red Book report, which tracks chain stores, their sample has been clearly showing slowing. So there's a lot of uncertainty right now about the consumer, and it used to be that we were confident that the employment, if payrolls remain strong, then whatever month-to-month swings we get in consumer spending, it really doesn't matter because the consumer is healthy. But that may not be, we can't be so sure after the February employment report.
Fair enough. I'll tell you what, I reckon the March employment report's going to be an interesting one. Okay, well, that's it then. Thank you very much for listening, as always, on behalf of Mark and myself. I'm off now to look for some more reliable seasonal adjustment factors, but whether successful or not, we'll both be back next week. Bye for now.
Econoday has provided value for the investment industry for over 25 years, amassing a comprehensive, machine-readable database of global market events. Our exceptional dataset consists of consensus, actual reported and revised numbers of economic events. Algorithmic trading firms, global banks, asset managers, hedge funds and AI technology firms are leveraging Econoday's unique historical dataset to fuel their proprietary trading models and support their research and compliance teams. Go to www.econoday.com and follow @Econoday on Twitter to learn more.